Hope everybody's on the freight train that's the S&P 500 because we just keep on rolling. Good evening, my fellow Riz Elite members and all of our subscribers here on YouTube. Welcome to our Elite webinar. Now, if you are watching the replay and are doing so on YouTube, do me a favor and get down there and you hit that like and subscribe button. Click the little bell icon next to it to get notified every time we upload a new webinar here on the channel because you're not going to want to miss anything going on with the market this year. And thankfully, we've got Riz back with us again this week. How you doing here, buddy?
Good, Chris, yourself?
I cannot complain. It is a busy, busy week. We got lots of things to talk about because the market has we cannot stop this freight train, it seems like. Every time we have a pullback, it seems like that just gets bought up and we just keep pushing. And that's exactly what we had this week. We just kind of started here, on Monday. It looked like it was getting a little red. We kind of ran into that 5,000 area, a couple times. I got really close to it on Friday. We ran into it a couple times here later in the week, and then we finally broke through it on Friday, making that big push up to a new all-time high for the S&P 500. I mean, Riz, it just seems like it's buy everything, risk off at this point.
Yep, precisely. It's like seems like we've kind of continued to see this massive overbought type of price action continue as exhibited by the RSI as well. As you said, anytime the market kind of goes red, whether it's a day, even two or three, it just gets bought up. We've seen that ever since November. It's been full steam ahead. In many ways, it just kind of goes parabolic, and then kind of maybe might get a little bit of a pullback. Not even, I wouldn't even call it a pullback, but just a little bit of profit taking, and then boom, gets bought right back up and goes even higher, right? So really the definition of rip your face off type of rally, as we like to say. And we've been saying that quite a bit. And for those that have, positions in their retirement accounts, have positions in, maybe passive investments, maybe in their 401k, they're all like everyone's happy, that's good. That's good. Because they're feeling good. They're feeling good about their investments. But I will say for those that are trying to trade a little bit more actively, a little more strategically, um, you have to be, I would say, a bit more cautious and hesitant. I've been cautioning elite members, obviously, for some time now. And of course, I can't get the timing precisely right. No one can. But this is where you really want to kind of manage your profits, manage your long positions. And for those that not in the know, long doesn't mean long from a time frame, but long it means just buying. So if you have long positions, you buy stocks, hold stocks, whether it's for days, months, years, you have to be very cautious. And I'm not going to go out and say, okay, well, try and time things in your retirement account or time things in your passive investments or your 401k. I can't, in good conscience say that. But for those that are looking to generate alpha, beat markets, be more strategic, this is that time to really, really kind of sit down and do an audit of what you hold, what your thesis is, how long you've held, and how much money you're making. If the profit's something that you're happy with, if your thesis has played out, I cannot in good faith say to just continue to just be greedy, because I think the time to be greedy was obviously the last 3, 4 months, and we've seen what happens when things run up this fast, this high. Usually, as we say in the business, stocks take the stairs up and the elevator down, right? So I'm not gonna go in and say, okay, well, we're gonna see a big crash or something, the deal. But I would not be surprised. We see, a bit of a pullback. We're gonna see some profit taking and then, maybe potentially a pullback. We did have the Fed, of course, also say that no March rate hike, Chris. Ding, ding, ding. We've been saying that for
Yep,
quite some time
nailed it.
already. And the Fed essentially just validated that, what we've been saying for months. And what's surprising to me is that the Fed has, gone on record and say that, Powell specifically, that they don't plan on cutting till at least after March. So forget the March meeting, that's off the table. But even after, yet the market has not priced out the gains. Up until now, the market was, pricing in a March cut, but that's no longer happening. So then it hasn't priced it out yet, which I find to be quite perplexing. And I'm sure many that sort of take a macro purview as well kind of feel the same way. But hey, here we are, right? We know the market can is ultimately this big microcosm, global organism, really, if you think about it, and none of us can exert our will on it, and all we can do is kind of position ourselves correctly and react accordingly. But hey, it refuses to kind of budge, and I guess the market's, I think, being extra euphoric from the standpoint that macroeconomic data continues to be strong, along with potential cuts. Even if they come after March, the market's thinking that's a perfect scenario. Rates coming down into a strong economy. Let's get juiced up.
Yeah, I have to agree with you. The fact that the market has not started to, kind of price out, what you're talking about, the lack of a rate cut in March, which obviously we thought was a little bit absurd from the beginning, and we are definitely vindicated by that. It is a little surprising that, given that and everything else going on, around the globe right now, that the markets just keep on chugging. It feels like it's almost disconnected from reality a little bit.
Yeah, it's not all bad actually in terms of what's going on in the world. If you think about it, a lot of economies are continuing to chug along. Some are doing better than others. Some have kind of stalled from a growth standpoint. But none are in such dire straits. Like, anytime we think back to um, recessions and really big bad economic circumstances, we always think back to 2008, 2009, and no one, no country, at least no Western country, um, is really in that boat. Yeah, China has really pulled back and their market reflects that, but China has a massive slowdown, a lot of kind of financial, um, I would say the foundations of their financial system are a little bit rickety. But other than that, like the Western world, well, developed economies, uh, they're doing decent, considering we've had higher rates globally, whether it's Europe, whether it's North America, we've had higher rates than usual the last 15 years. So and this rising rate environment across Europe and North America for the past year and a bit, maybe 2 years even, uh, has kind of been absorbed by the consumer, right? So I'm not surprised in some ways that the economy is looking good, investors are feeling bullish. I just feel like it's too much, right? And yeah, if you separate the geopolitical tensions and all that kind of stuff, which no one can control, no one is really um, able to discern a start or a finish from a timeline perspective. So those things will always be kind of overlooked. But from an economic standpoint, it's not looking too bad. It's actually, yeah, there's some, cracks there, but when we look at things objectively, it's not all bad.
All right, well, that sounds good. Let's take a look here at the breakdown for the S&P 500 and see what's going on and what is really gaining from this rally that we've been having. And unsurprisingly, it is tech and communications really getting those gains for the most part. We're seeing here consumer discretionary starting to pull up a little bit, but we are starting to see some other sectors come up. We're seeing healthcare starting to rise a little bit. Financials are staying mostly stagnant along with consumer staples. Energy got a little boost and now is really kind of consolidating. Same for real estate and utilities. Let me switch it to the year to date here so you can get kind of a better idea of where we are for the year so far. Tech up 10% on the year so far, which is just crazy. Communications right behind it, about 9.6. But the S&P 500 itself is up 6.15% on the year, and we're not even, through the first quarter yet. So there are a lot of things going on. You can kind of see that slow rise here in healthcare and financials kind of staying stagnant for the most part. But yeah, it seems like we're seeing more of what we saw from last year with tech and communications taking the lead. But there's a lot of time left before we get to December 31st, I'd say.
Yeah, yeah, it's kind of the continuation of 2023 with tech and communications is running, leading the show. And what I find to be pretty extraordinary is just the last it's February 10th today, as we're recording this live. We're a month and 10 days into the year, and the SPX, the S&P 500, is already up 6%. That's extraordinary, right? That's quite a bit. And we know that once the market runs, it can definitely run, as we talked about in the last chart. But like I've said before, it doesn't necessarily mean that all is going to be fine and dandy for the remainder of the year. So we need to make sure that we are positioned correctly. I'm not saying outright that we should go start shorting everything yet, but we definitely rather err on the side of caution, especially with the big run up the past 3, 4 months.
Yeah, and I think that's a really good point. It's like just because we're not taking, saying, oh, yeah, jump on this rally, go for it, doesn't mean to short everything either. Because, like you said, the things this is something I'll remember, securities can be overbought and stay overbought for some time, and that can include the market itself. And it doesn't mean that it's just because something is overbought or oversold. I mean, you just go the opposite direction right away. So definitely be careful. Make sure you're positioned properly, and be ready for whatever may come our way. And that's just a great thing to live by in general. Well, let's keep this rolling. Let's take a look here at the asset classes now. We did have a bit of a dip in oil last week. We kind of looked like we were starting to bottom out, but we definitely got that bought back up, right back up over the 76 area. Looks like we closed the day at 76.84 per barrel on light crude, which are the futures at least, and that's what we are, keeping an eye on here. And then gold is really just kind of not doing anything and mostly consolidating for the most part. Really kind of hitting this ceiling around 2050 per ounce, and it just doesn't seem like it can bust over it. We had a test that looks like on the first, so last week, last Thursday, we kind of tested that and rejected pretty hard, and really just not doing a whole lot. But yeah, obviously, Riz, what was the deal with this sell-off in oil that we had here? And then obviously we had this quite big buy up here this week.
Yeah, usually just basic supply, supply demand, as we know, oil, pretty much all commodities primarily, but specifically oil, especially on the North American side and specifically the US, we can see inventory levels, we can see, whether there was a draw, meaning there was, a decrease in inventory, or there was a build up, or an increase in inventory. And of course, that's directly correlated to demand, right? So, I wouldn't, look too much into last week's drop. It was just kind of normal, but it remains to be seen now that we're back above the 76 area, if that kind of trend from the $70 low in November, December last year, kind of looking up a little bit. If you really think about it, think like of a trend line, an upwards trend line, kind of seems like that's what it might be. I'm not gonna come out and say that, yeah, I think we're gonna see 85 level, but this does bode well from a bullish standpoint for crude prices going forward.
Definitely something to keep an eye on if you do like trading commodities. Oil definitely a good choice if that's something you like to do. Let's take a look here at the bond yields, because this obviously kind of gives us a clue as to where the market is at, and we're definitely seeing a very nice rise in bond yields this week. Kind of after last Thursday we had a little bit of a dip. We definitely started to rise up here, and we've kind of finally separated a little bit with the 2 year and the 30 year finally separating. They were fighting with each other for the better part of January for the most part. But definitely the 2 years are running hotter now as they were before, with the 10 years still kind of lagging, but still respectable at 4.17% yield on those bonds. The dollar has been making some definite gains here over the last month, and honestly, for pretty much all of 2024 so far, a very nice uptrend here on the dollar. It seems like we make a leg up and then we consolidate, then we make a leg up and we consolidate, and it looks like we made another leg up, and guess what we're doing? We're consolidating. So, Riz, what is this kind of stair step pattern that we're seeing here with the dollar? Is there something behind that?
So the most recent stare, like you mentioned, I think that's probably primarily based on the Fed, remarks around keeping the no rate cut. Remember, I mentioned, if we see rates higher, that bodes well, kind of like a floor or like a stabilizer for US dollar. And we're not anticipating rate increases, but just being held. That bolsters the US dollar strength, right? Because the rates are going to be held, for what seems like beyond March. Who knows, maybe. Uh, how that goes. But right now, it's boding well for the dollar. In terms of the bond yields, those two have picked up predominantly after the Fed remarks as well. So we saw quite a bit of think of it like a reaction, right, post the confirmation of the Fed decision and Jerome Powell's conference. Uh, and not surprising that March cuts are off the table. The economy continues to be strong. We're really going to be in, I would say, no man's land, uncharted territory after March. And I think that's where things are really going to get interesting, where when that cut is supposed to be coming, does it get further delayed? Then I think the market might start getting a little bit of jitters, right? So, March isn't too far away. We've seen 2024 just zoom by, continue to zoom by. I'm yet kind of perplexed, just like all the time, with how fast time continues to fly.
Oh yeah.
But it'll be interesting. We see the bond yields go up, and then mortgage rates once again touched 7%. So we had a little bit of a reprieve the past few months as they dropped, to 6.5, but now back above 7 mortgage rate. So uh yeah, let's see, right? We're continuing to stay in this kind of higher rate environment, and it's really gonna come down to how does this ultimately impact consumer um, spending, and are companies, corporations, businesses, and consumers going to be able to just continue to chug along and absorb this higher cost of borrowing, essentially higher um, cost of living, and a little bit of weakness in spending from a consumer standpoint.
Yeah, and we'll touch on that a little bit later, but let's take a look at the key dates for the market and, of course, the earnings calendar. And if you are here live on webinar and you'd like to post a question for Riz or myself or both of us, please feel free to do that in the chat right now as we go through this, because let's take a look here at the important dates for this week, because there are a couple. Now, as I said last week, there really wasn't anything to keep an eye on as far as dates in the market, but this week we've got some good stuff to be keeping an eye on, especially with this inflation rate, tick. Both core inflation and the traditional inflation rate are both month on month and year on year are going to be reported. It looks like they are forecasting inflation to go up a teeny bit or down a little bit, depending on how you look at it. Retail sales for January are going to be very interesting, obviously coming off of the Christmas season. And then we've got building permits, kind of giving us idea of the health of the construction area. PPI is another interesting one to keep your eye on as well. That's the producer price index, if I'm not mistaken. So definitely, I think Tuesday is going to be kind of our big day, honestly, because if these prints come out, hotter than expected, that could definitely make the market react or shudder a little bit. But if things are still in line, I don't think that it's going to be a huge, catalyst like it has been in the past. What are your thoughts, Riz?
Yeah, I agree. I think inflation is expected to come in line. I don't think it's going to be a hot print. I think we've kind of gotten past that, unless something drastically changes. I think, we're going to settle in around this 3% annualized year over year kind of inflation rate. And hopefully, at some point a dip into the twos, uh, because the Fed's mandate is to get it back down to that 2.5%, as soon as it can. Hence why they're continuing to hold rates as opposed to cutting, right? You're absolutely right. Tuesday is the big one. With Friday, the producer price index also kind of matters, but definitely kind of not the big one. Inflation at 8:30 a.m. Eastern is going to be the highlight. But simply put, I don't think it's going to be too big of a catalyst, as you mentioned, like it used to be back in 2022 and 2023.
Yeah, back in the inflation days, at least we don't have to worry about that. as much, I would say. But yeah, if it's a hot print, that's not good. Let's take a look here at the earnings calendar because we've been having a lot of earnings pushing the market a bit as of late. And we definitely have more coming in this week. Now, I'm going to go out on a limb here and say that Monday is pretty much a non-starter for earnings. I don't think any of these are really big names that you need to be keeping an eye on. But Tuesday, we've got some big names. We got Coca-Cola. We've got, if you hate it or love it, Shopify is on there. Let's see, Hasbro, another big toy maker. That's a decent sized one. Airbnb. Let's see here. Yeah, nothing too big. We've got some banks reporting. Kraft Heinz, that's going to be a decent one to keep an eye on. Let's see what else. I'm not seeing. Twilio is one that day traders like to trade. Not saying that you should do that. I'm just letting you know that that happens a lot. John Deere, another one that gets a little bit of looks here and there. But I would say, honestly, most of the big names have already reported. We've had the Apples, the NVIDIAs, the Microsofts. We're now kind of getting into the bottom of the barrel. So, Riz, is there anything here that I missed that you're going to be watching?
No, it's something like you said, yeah, the most larger names are done. These are smaller, um, I wouldn't say small, but like definitely smaller than the big ones, definitely keep an eye on Shop, Airbnb, Datadog, Coca-Cola, obviously we got Robinhood as well. Everyone's favorite, not so favorite brokerage.
I
Um,
knew there was a joke coming there.
yeah, right. So we got also like you said, Twilio, yeah, from a tech standpoint, Oxy for oil. We know Warren Buffett's kind of been trading that the past year and a half, and I believe he actually increased his stake again. He did sell before, but then now he's building a stake again. We also have, like you said, John Deere will give us an idea as to how industrial equipment side of things are going. We've got from the DraftKings from the more you know, gambling side of things, Coinbase for the crypto brokerage, Roku and Trade Desk, both large movers on the tech side of things. But yeah, other than that, definitely a slower. I wouldn't say slower, but definitely the kind of the crescendo of earnings season here, really coming to a close with the big ones, the past 2 weeks already done.
And don't forget everybody's favorite, shoe brand, Crocs here. That's definitely one you need to be keeping your eyes on. Especially if you like holes in your shoes. All right, let's go. We've got a couple questions coming in, but I know there were some data points, Riz, that you kind of wanted to touch on here. So I'll let our members get their questions in a little bit more. Wanted to touch base on NVIDIA because this was a very interesting thing that you brought up to me before the webinar. And we're saying that the basically the market cap for NVIDIA is now over $200 billion, and that's higher than all of the energy companies on the basically the energy sector for the S&P 500 combined. But the income is complete. There's a huge disparity between income with the income for the energy sector being about 147 billion with a B, compared to 19 billion for NVIDIA. So Riz, why are what is the deal with NVIDIA here? Why is this valuation so high?
It's ridiculous. I mean, AI and obviously Facebook and also Tesla going on record and saying they're buying a bunch of NVIDIA chipsets and all their stuff for their data centers and AI and computing and all that. So NVIDIA has just been completely crazy with a lot of funds going in, retail backing in there as well, and then of course analysts coming in of course, late and just randomly just increasing their price targets. So this has just gone absolutely bonkers. Keep in mind that in 2023 it was sub $200 stock, right? And now we're looking at it 721. It is essentially to recap what Chris was saying. Nvidia alone is $200 billion market cap more than all U.S. energy companies combined. You take all the U.S. energy companies, think Exxon, Chevron, ConocoPhillips, everything, and you combine all of them, and Nvidia's $200 billion more than all that. And then from an income standpoint, all of the energy companies, they make roughly about 147 B with $1 billion in net income, whereas NVIDIA makes 19 billion. So this goes to show you the enormous, exorbitant, I would say, mismatch in valuation and pricing. And we've seen this. NVIDIA is not the only one. We've seen this with other companies in the past. Cough, Tesla, cough, you know, and we know that ultimately, as time goes on, reality effectively, sinks in. And no matter what, the higher you kind of aim uh, to go towards the sun, the closer you want to fly to the sun, the more you have to lose. And ultimately, NVIDIA really looks like it's fits that bill. So, they also have earnings coming in the next couple of weeks, I believe. So it'll be interesting to see, how that plays out. I'm sure they're going to do good from a number standpoint, but they're priced at such a level that it's almost like they're like the entire weight of the world is on them because of expectations. And I don't think no company, NVIDIA or otherwise, can meet those kinds of expectations again and again and again. So it remains to be seen when that shoe eventually drops, but it'll be interesting nonetheless. But it goes to show you the massive mispricing. And another stat when it comes to NVIDIA is NVIDIA's market cap is pretty much bigger than all of Chinese stock market. So it's absurd. It's absurd. Um, but hey, you got to be there to see it and then hopefully take advantage of these opportunities.
No, I mean, you got to make sure you have your bingo card ready for the earnings call, or the conference call for NVIDIA earnings, and make sure you get your bets on how many times they mention AI to see if you get the winner this time around. That's our little joke running here. Let's go ahead and take a couple of questions here because I like this last one. This last slide you sent me, I think is going to be a great one to finish on. Axel wants us to know what are our thoughts on Boyle? Well, out of the frying pan and into the fryer. So this is a natural gas. If I'm not mistaken, this is this a leveraged ETF, Riz? I can't
Yep.
recall off the top.
Yeah. We've traded this before. Ultimately, it's obviously a lot of DK. We're not buying this. Natural gas has been decimated because of massive supply, not enough demand. Warmer winter has also played a hand in that, right? Natural gas demand is really high due to uh, you know, requiring heating and more demand in the winter months. But because we've had a weaker, I would say not a weaker, but a warmer winter, that's led to less demand, right? And supply continues to be cranked up. So there's a lot of natural gas inventory sitting there. And as a result, it's just hammered the natural gas prices, I think, to a 3.5 year low. So to go out and buy natural gas right now with a leveraged ETF, yeah, it's definitely mean, if you want to dip by, this is time, but we know what goes low can go lower. And obviously, natural gas isn't going to go to zero, but I wouldn't say that you want to be able to do it with a leveraged ETF like this, right? So it's all going to come down to timing. If you do take a long position on something like this, make sure you're not holding on to it for weeks and weeks, let alone months, because there's a lot of decay in this. So be aware of that. Um, but yeah, I feel like natural gas is completely oversold, decimated, uh, but we can see that, of course, from a supply and demand standpoint, it does make sense in a way, right? We know that we're already well into February. We got March before April really starts picking up for spring weather. So it remains to be seen how prices ultimately go, but I do think it's completely oversold.
Yeah, I mean, the last couple of winters, honestly, have been pretty low. And I mean, especially in Europe, where it looked like they were going to be, more dependent on US LNG. They didn't really need as much over the last couple of years because it's been so darn warm. And I can say it was like 60 Fahrenheit here the last couple of days. I mean, it's unheard of in February here in Indiana, where I'm at. So yeah, LNG is definitely taking a hit. Now, obviously, if I recall, didn't President Biden say that he was going to be pausing LNG exports? I recall hearing him say that. So that could definitely play a role in that price as well.
Yep.
All right. Nikhil has a question. He wants to take let's take a look at CHTR, Charter Communications on the buy side. Well, that is a knife catch if I've ever seen one. Holy cow. Well, not a big miss on earnings. Well, yeah, actually was quite the miss on earnings here.
Yeah.
So yeah, they missed pretty hard and they got punished for it. Yeah, I would expect the 20% miss on earnings to be punished pretty bad. Does look like we're starting to come back up here. So I mean, as far as a buy the dip play, it definitely looks like it's a good spot to get in. But man, with a drop like that, Riz, is that enough for you to say, yeah, let's go for it?
Yeah, this is something I looked at post earnings. You know, obviously they missed quite big, and I wouldn't be surprised if also guidance was also lowered. Hence, the big drop. This is a telecom, so to see this kind of move in it is definitely not the norm. It was definitely oversold. They're still a little bit oversold. So, I think if you really want to do like a dip buy, this is it. The fact that we had a Friday green candle bodes well. I'm not confident if I'm going to take a position, but I cannot fault anyone for taking a speculative long on this.
Yeah, it definitely looks like it's starting to kind of come back up a little bit. So it's something you could consider if that's the type of play you like to make. But I wanted to go ahead and close the webinar on this last point because I think this really kind of hammers home, a lot of our feelings as to the state of the economy and why this run up in the market seems a little overdone, if you ask me. So Riz sent me this, and we're talking about debt in general and the amount of debt that the American consumer is holding. Apparently now, as a collective, Americans hold about 1.13 trillion with a T in credit card debt, which is an all-time high based on numbers reported by the Federal Reserve. To compound that, we now have a record 17.5 trillion in household debt, a record 12.3 trillion in mortgages, 1.6 million in auto loans, close to record numbers of 1.6 trillion in student loans, which they just started making people pay back again, if I'm not mistaken, and a record 1.1 trillion in credit card debt. So it's like we keep seeing people taking on more and more debt, and I mean, that doesn't bode well. I mean, especially with interest rates going up and up and up, because I know most of those credit cards are not fixed interest rate credit cards for the most part. So yeah, Riz, what's the deal with all this debt that Americans are taking on?
Yeah, well, they have no choice, right? Rates in one of the fastest rate hiking cycles ever. Off the back of a pandemic, which completely, changed people's spending habits. They changed their savings rate. Savings rate did go up, but it came back, and it came back very strong in terms of people spending. And guess what? Eventually the money does kind of run out, and when you have higher cost of borrowing, higher cost of living, inflation, one point in 2022 was 9% annualized. Guess what? People are financing their lives, their day-to-day and their extracurriculars via debt. And at some point the music is going to stop. We don't know when, whether it's going to stop abruptly or if it's going to just slowly, the volume just going to come down and then fade. But we do know it's going to stop, and that's going to play into the economy, right? So my view is that it will happen. It will take a hit, and there will be a strain on the economy once the affordability gets to that point where it's like, whoa, we see a little bit more defaults, we see a little bit more further delinquencies in credit cards and car loans and personal loans. And then, we see further slowdown and impact in spending and purchases across the board, whether it's consumer staples, consumer discretionary, obviously. And, as a result, we see that impact, the broader economy. That's my view. And I'm not a doomsayer. I'm not saying, I want the economy to collapse, or like, I don't think it's not gonna be a collapse, but what I'm saying is a slowdown. And I'm not saying that I want the market to crash or anything, but even a slowdown would not surprise me in the later part of the year, right? So in that sense, that's why Chris is highlighting that, and I think it's important to be aware of this, uh, because not everything is just the price of Apple, and not everything is, what NVIDIA stock price is, or where the S&P 500 is, right? We have to look at macro data, but also be aware of kind of like the data and the numbers on the ground level, right? And doesn't get more granular and ground level than the average consumer and the average person in America, right? So I think it's important to highlight that apart from just charts and trend lines and candlesticks and RSI.
No, it's a really good point. What the average consumer is feeling on the ground or in the trenches, as you might say, is definitely different than what we're seeing on Wall Street. So there's definitely a bit of a divide there. And yeah, the average consumer, as you said, is basically fighting inflation with debt at this point. And so that brought up a question from Keely. Says, excuse me, they say, any idea when we'll see mortgage rates come down further, or even if we will? Well, history would say that eventually it will probably come down, but I mean, I don't think we're going to start seeing mortgage rates come down until we start seeing rate cuts from the Fed. Wouldn't you say, Riz?
Yeah, I agree. I think they'll start coming down the moment we start getting a better indication of when the first cut will be. Because mortgage rates they follow the 2 and 10 year bond yields, and those obviously are forward looking, and they will also kind of start pricing in rate cuts. But uh, that's the reason why we saw mortgage rates go back to 7, right? Because the Fed kind of tempered expectations of that imminent rate cut from March to further out. So you will start seeing mortgage rates come down, but that won't happen till we get a little bit more clarity around when that first rate cut will come. And you'll see the mortgage rates come down before the cut even happens.
There you have it. So keep an eye on those rate cuts, see if they're coming anytime soon. Spectacular questions from everybody here. Thank you so much for coming out. I really appreciate each and every one of you. And of course, everybody watching on the replay, we appreciate you as well. Make sure you hit that like and subscribe button on the way out, and we'll see you in the market on Monday.